Okay, students, we were discussing the concept of the depreciation and some of the basic things that we have discussed. First of all, depreciation is what? Depreciation is an expense. Okay, now, and the basic definition of the depreciation, the allocation of cost of asset over its useful life. So we have four main things are there. First of all, we have to consider the cost of the asset, and which asset we have to consider the non-current asset. Okay, and the third thing we have to consider its useful life. And then what is the depreciation? It is basically the distribution. So we have paid the paid the total amount, for next 5 years, 20 years, 30 years. So what we have to do, we have to distribute that, we have to allocate that. Okay, now depreciation is what? Depreciation is an expense. Now the second thing, it is for the non-current asset. And which non-current asset? The tangible asset, the physical assets. Okay, now we have some of the examples here. The depreciation for non-current assets. So what are the non-current assets? It may be a land, it may be a building, it may be a vehicle, it may be a machine, it may be equipment, it may be furniture and fixture, it may be tools, or anything which is in the use of the business, which has economic value and the life is more than 1 year. If you see here, we have written there that there is no depreciation for the land. Why there is no depreciation for the land? Okay, very simple thing, because we are not considering the useful life here. We are not sure that the land is for 10 year, 20 year, 40 year, because the life of the land is infinite. We cannot calculate, we cannot assume the life of the land. So that's why we are not depreciating the land. Other than land, all the non-current assets which are tangible will be depreciated. We just took an example regarding the building. So all this information or all this example will be related to the building. So we assume that the cost of the building is how much? That is $200,000. And then the expected life, or what we say the useful life of the building, is how much? That is 20 years. Now the depreciation, the very basic, the very simple one, the depreciation is how much? That is 200,000 divided by 10,000. So we can say like almost $10,000 per year is the depreciation. So the expense of 1 year is how much for building? 10,000. For 2 years, 20,000. So it means for 20 years we have paid 200,000 the cost. So this is the expense, and this expense or this cost basically we have distributed not on the 1 year, because we are getting the benefit from the building for next 20 years. So the cost should also be distributed on the next 20 years. So that's why we are considering it with the life of the asset, the useful life of the asset. Now here there are many different methods of calculating the depreciation. But here we are taking the very basic method. Obviously we will do, or we will calculate the methods also in the next sections, the different types of the depreciation. But here we are considering the very basic method, and that method is called as the straight line method. So it is the straight line method of the depreciation, and the formula is simple: the cost of the asset divided by the useful life of the asset. So we can write the formula here: the cost of non-current asset divided by useful life of non-current asset. And again, this is expected useful life. So we assume that this building will benefit the business for next 20 years. So it may be for next 25 years, it may be only for 15 years, but we are just estimating on the condition of the building that it will be used by the business for the next 20 years. So now the cost of the non-current asset, the cost of the building is 200,000 and divided by 20. There's one more thing that is very important here, that sometime when after the life of the asset, when the life of the asset is finished, it has some value, it has some economic values, it has some market value at the end of the life. So let's assume that we purchase this building in, let's say, in 2020. Now after 20 years, like in 2040, this building will have some economic value. It may be like 20,000, 30,000, 40,000, depending on the condition. But again, it is an estimate that this building will have some economic value at the end of its life. So that is called what? That is called the salvage value, or what we say, the scrap value. So salvage value, residual value, or the scrap value. So we are considering that also in the next calculations, but here we are just assuming that the salvage value or the scrap value or the any type of the, you can say, the residual value of this asset is nil. So this is for just for the simplicity purposes. In the next lectures, we will obviously discuss the concept of the salvage value and how, if there is a salvage value, how the depreciation will be calculated. Why this method is called a straight line method? Because this is the depreciation of $10,000, not for 1 year. This is for year 1, year 2, year 3, up to how many years? Up to 20 years. So the amount of the depreciation will be same. So if we make a graph, so it will be a straight line, 20, 20, 20, like a fixed amount will be there. So that's why it is called as a straight line method of the depreciation. So this is the basic thing, how depreciation is calculated. Now we will go to the next concept, that if we are buying an asset, if we are purchasing an asset, so how it will be recorded in the journal, then how the depreciation will be recorded in the journal. Again, for the simplicity purposes, for the basic concepts, we will assume that this asset is, for example, purchased on the 1st January 2020. On the 1st of the January, they have purchased this asset. And which asset they have purchased? They have purchased a building, and the value of the building is 200,000. And again, we are assuming that they have paid a cash for that. So the basic entry is what? That the building account is debit, and the cash account, we assume that they have paid the cash for that, that the 200,000 will be credit. So purchased office building. Now this is the very basic entry. I hope you understand, because the non-current asset is there, and if there is non-current asset, if you are buying the asset, then the asset is increasing, so that will be debit, and the asset in the form of the cash is decreasing, so that will be credit. So that is very simple one. We have discussed it in the previous examples or in the previous lectures. Now, how to deal with depreciation in the accounting, how we will write the debit and the credit. So for this purpose, we should understand that depreciation we have calculated for 1 year. So it means depreciation will be written when the financial year will close. So just again, for the simple purposes, on the 1st January 2020, this asset was purchased. Now, when the financial year will complete, obviously we will say that it is completing on the 31st of December 2020. Now we have to record the depreciation, means we have purchased this asset on the start of the year, and almost 1 year is completed and financial year is also closing. So now we have to write the depreciation, because we have used this asset for the whole year, this building for the whole year. So we have written it as an asset, the cost is written, but now we have to write that how much we have to consider as an expense for the first year in the books of the account. So on the 31st December, what we will do, we will write the depreciation. So the depreciation has a very simple entry that is called as the depreciation expense. And we will mention that depreciation for what? That is the depreciation for the building, because it is an expense. Expense is increasing, and that will be debit. How much amount? That is $10,000. Now, the second part is a little bit tricky, that what we say it as a accumulated depreciation. Okay, accumulated depreciation that is what? That is not an asset account. It is called an contra-asset account. So let's make the entry, and after that we will understand, or we will discuss what is the concept of contra-asset account. So we will write accumulated depreciation for building, and that will be credited by 10,000. So this is 10,000, 10,000. So depreciation for first year. As in some of the books or some of the lectures, they are writing it as a building is reduced, but we will not write like that because it is not according to the international accounting standards. So accounting standards says that we have to create another account for that, so it is called as the accumulated depreciation. So what is the accumulated depreciation? Accumulated depreciation is just the total of the depreciation. So the first year it is depreciated by how much? That is depreciated by 10,000. So it means the value of the asset is depreciated by 10,000. So for 1 year or first year total accumulated depreciation will be 10,000. Now the same entry, because we are using the straight line method, the same entry will be recorded in the books for how many years? Obviously for the next 20 years. So for year 2, year 3, year 4 means on 31st December 2021, 31st December 2022 up to next 20 years. So the same entry will be recorded, but here only change will be, it is not for the first year, it will be for the second year. The same entries will be recorded for 2023 December. So all the years the recording will be same. Now what is the concept of the contra-asset account? Contra-asset account means that which reduces the value of the asset. Means 1 year is complete, we have recorded the depreciation. So the depreciation is an expense, and we will write that expense in the books of the account in the income statement. But when we are writing the asset in the books of the account, what we will do, we are not writing that asset or the cost of the asset as a 200,000, because 1 year it is used, so it's depreciated for 1 year, so 10,000 is reduced. So it means now its value is not 200,000 in the books. Book value, or what we say the net book value, is only 190,000 because it is depreciated by 10,000. So we have a concept of accumulated depreciation. Accumulated depreciation is simply the sum of the depreciation over the years. So accumulated depreciation is sum of depreciation over years, that is depreciated, and that is basically the contra-asset account. Contra-asset account means what? That which reduces the value of the asset. Which asset? The non-current asset, because it is reducing the value. It is what? It is allocating the value for 1 year, 2 year, 3 years. Every year the book value will be reduced and the depreciation will be increasing. The accumulated depreciation will be increasing, but the depreciation expense will be same for every year. So here we have recorded the transaction. So for year 1, year 2, year 3. So this is for the first year complete. It is for the second year, for third year, for fourth year, up to how many years? Up to 20 years. The same recording will be there, that you are depreciating the asset. So how we will write the accumulated depreciation in the accounts? Obviously we have to prepare the T accounts. We have to prepare the ledgers, or we have to prepare the accounts. So that account, the building account, is the cost of the asset. So that account will be there in the statement of financial position for the next 20 years. So it is the real account. So then the expense, every year expense account will be there in the income statement, 10,000, 10,000 every year. But the accumulated depreciation will be increasing. That is the asset account, not the specific asset, but the contra-asset, which reduce the value of the asset. We will decrease the value of the asset every year. So that's why we are getting the book value by using the depreciation. So this is the concept that how depreciation is calculated. So we have the depreciation and how it is calculated. So now I will tell you that how this accumulated depreciation will be written in the books of the account and why we call it as an contra-asset account. Now depreciation expense 10,000, this will be in the income statement. Okay. So year 1, year 2, year 3, so every year it will be same. The next thing that is important, we have to calculate what? We have to calculate the net book value. Now, what is the meaning of the net book value? That after 1 year, the cost of the asset is there, 200,000. It is depreciated for 10,000. So it means the book value reduced by 10,000. So the book value will be 190,000. So the net book value, we have very, very simple formula, very basic thing. And the cost minus accumulated depreciation. So year 1, the cost is how much? The same, 200,000 minus accumulated depreciation is 10,000. So it will be 190,000. So first year expense, how much? 10,000. Building value, same, 200,000. Then the accumulated depreciation for year 1, so that is 10,000. So next year what will happen? So this is the depreciation forward for the first year, for the second year, for the third year. So the same entry will be there, the same expense will be there from the year 1 to year 20. So the amount will be same, the expense will be same, and the income statement, the return value will be same. But when we are talking about here the net book value, because it is based on the accumulated depreciation, so for the year 1 it is like that. So 200,000 is the cost minus 10,000, so the value is 190,000. So its book value, or what we say simply, the net book value is 190,000. For the year 2, when the year 2 will end, means next year again we will make the same entry. So the depreciation expense, and we have accumulated depreciation, the same entry, 10,000, 10,000. Now depreciation expense of the building has how much balance? 10,000 for the last year, 10,000 for this year. So it means in the next year, so we have a 200,000 minus 20,000. So the net book value will be 180,000. So year 2, the value reduced from 190 to 180. So in the start of the year 1, it was 200,000, the building value. Then at the end of the year, 190,000. At the end of the year 2, it is 180,000. So in the same way, we will keep on making the same entries. And what will be the value at the year end of the year 20? Okay. So at the year 20, like this, with same entry, at the year 20, it will be 200,000. And now, because the depreciation is also 200,000 up to now, we have depreciated the accumulated depreciation account, so the book value will be 0 or it will be nil. So now, what is the basic thing? That this depreciation, accumulated depreciation, is added on every year. First year 10,000, second year 20,000, third year 30,000, 40, 50, 60, up to the last year. That will be the depreciation, accumulated depreciation, and the value of the asset, the cost of the asset is 200,000 also. So the balance, or what we say, the book value will be nil. Now there is one very basic thing that we should consider, we should differentiate between the book value and the concept of the market value. Market value is a bit different. Okay, so here if you see, the book value of the asset after 1 year is how much? That is 190,000. But it doesn't mean that if you want to sell the building after 1 year, it will be sold for 190,000. So it may be sold for, let's say, 210,000, it may be 250,000, it may be sold for, even if the values are reducing, 150,000. So don't mix the things. The net book value and the market value are totally different thing. Market value is the value of the asset what is available in the market, or if you want to sell it in the market, so that is the market value. But the book value is just written in the books of the account or in the record of the account. So in the record of account it is 190,000 after 1 year, but in the market the value may be more, market maybe value will be less. So we are not mixing the thing, we are just writing it in the books of the account. We are not concerned what is the market value. If there is a major change in the market value, then there is a revaluation process. That is some other concept that we will discuss later on. But here, very basic thing, that the net book value is just the value which is written in the books of the account for the 1 year, 2 year, 3 year, up to 20 years. And when the 20 year, the life of the asset will complete, the net book value will be nil or it will be zero. So this is the concept of the depreciation and how it is recorded in the books of the account.